So in this video, I'm going to be going over how people can actually profit off futures, how exactly they work. The videos I've made up until now are sort of more conceptual, don't really explain how people can profit off them, and in this video, I'll be going over just that. So we'll start off with a simple example as always. Let's say, first we think of, let's say, a stock in the market, okay? Let's call it stock X. Okay, and stock X is currently trading at $10 a share. Simple enough, okay. Now we have two parties. Let's say we have A and we have B, okay? And as you know, stock prices keep rising and falling based on your information. In financial markets, they change from a day-to-day, hour-to-hour, even a minute-to-minute basis. So A and B have different views about what's going to happen to this stock right here. Let's say A believes that this stock is suddenly going to rise like exponentially in the next 10 days. He feels that this price is going to go way up in 10 days. B feels the exact opposite. B feels that the price of this stock is going to like plummet in the next 10 days. In order to profit off that, they can engage in what's called a futures contract. So they set up a contract. Okay, keeping in mind, A thinks the stock price is going to rise, B thinks that the stock price is going to fall. They can set up a contract, each with their own distinct beliefs, where A will actually give B $10 and B will sell the stock X in the future. And let's say the timeline we set is 10 days. In 10 days, A expects the stock to like go insanely high, B expects the stock to fall insanely low, and the 10 days is sort of our maturity date for the contract of setup. So in 10 days, A will give B $10 and B will sell stock X to A. Now, we consider two separate scenarios. Now, either the stock price can rise or it can fall. So we consider the situation where it rises. Let's say in 10 days, or let's say even before that, let's say in 5 days, this stock price goes huge. It hits $100 from $10. Amazing, that's really good news for A. So what he can do now is that in 10 days, the stock price has shot up to 100 in the financial markets. And he has this contract which allows him to buy stock X for only $10. Now, to sort of make it more obvious, it's trading in the market for 100. A can buy for $10 because of his contract. So what he's going to do now is that after 10 days passes, they're legally bound by this contract that they set 10 days ago. A is going to pay $10 to B, and B is going to give him stock X. A just bought stock X for $10. He can go sell it in the market for $100 and make a profit of $90. So A ended up being the winner in this case. B, however, ended up being the loser. He had to sell the stock for $10. He was legally obligated to, even though in the market it was trading for $100. So that's what happens if the price did in fact end up shooting really, really high. But let's consider the inverse scenario where the price was $10 and let's say the next day the company goes bankrupt or something, the price falls to, we won't say zero, let's say $1. It was 10, now it's $1. Now, 2 days and 10 days pass, A and B are still bound by this contract. So what A has to do, A has to pay B $10, even though the stock is worth $1 now. A has to pay B $10 and B has to give him stock X. So what basically B has the option, 10 days pass, B goes in the market, buys the stock for $1 and he sells it for $10. He receives $10 for stock he only bought for $1 in the market because the price has gone down significantly. In this situation, since B's prediction about what was going to happen to the stock actually ended up being true, B ends up being the winner in this case, and A sort of ends up being the loser. The stock price fell, so A has to pay $10 for a stock that's only worth $1. That's $9 sort of loss that he made from this situation, and the same $9 that he lost went to B because that's the profit that he made. Because in futures, it's sort of a zero-sum game. When one party loses, the same amount is the gains of the other party. So through this example, you've sort of seen why people use futures. It's sort of to speculate in the market, and if you follow financial news, you'll often hear about derivatives being really, really speculative in nature. Both A and B were sort of speculating, making guesses about whether the price of the stock was going to go up or down, and based on that, one of them made a huge profit and the other one lost in different scenarios. So that's sort of how futures can be used to make a profit.